Welcome back, ladies and gentlemen. Whether you're a seasoned pro or just starting out, if you're on the lookout for that one trade setup to elevate your trading game, you're in for a treat. Today, we're delving into the world of fair value gaps and inversion fair value gaps, powerful concepts that can revolutionize your approach to trading. But before we dive in, make sure to hit that like button, subscribe, and turn on notifications so you never miss out on valuable insights for your trading journey. Let's start with the basics. What exactly is a fair value gap? Picture this. You're analyzing a price chart, and you notice three consecutive candles. The middle candle, known as the fair value gap, stands out because its body doesn't overlap with the bodies or wicks of the candles on either side. This unfilled body represents a gap in fair value, indicating a potential imbalance. While the gap may not be filled immediately, it creates a magnetic pull, drawing price back to fill it at some point in the future. Why are these gaps so significant? Well, once you grasp their importance, you can leverage fair value gaps in multiple ways. Targets. Fair value gaps serve as natural targets for price movement. By identifying fair value gaps, you can set profit targets for your trades, capitalizing on the tendency of price to revisit these levels. Liquidity. Within the realm of fair value gaps, you'll often find pockets of liquidity. These areas can act as catalysts for price action, attracting buyers or sellers into the market and influencing short-term movements. Support and resistance. Fair value gaps also function as dynamic support and resistance zones. As price approaches these levels, traders anticipate either a bounce or a breakout, depending on the prevailing market conditions. Entries. Fair value gaps provide high probability confirmation to good entries and exits. Let's illustrate these concepts with some real-life examples. Targets. Consider a scenario where a lower time frame chart reveals a buy signal aligned with a fair value gap. Traders could strategically target the fair value gaps as an area for price to reach, aiming for a successful retracement. Liquidity. In another instance, equal highs form within the confines of a fair value gap. Observing the market dynamics, we notice how price manipulates these levels to induce trades in one direction before swiftly reversing, highlighting the role of liquidity within fair value gaps. Support and resistance. Here, we witness a prime example of price utilizing the fair value gap as support. By respecting the boundaries of the fair value gap, price demonstrates its reliability as a key structural level in the market. Now that we've covered the basics of fair value gaps, let's take it up a notch with inversion fair value gaps. Imagine a scenario where a future candle violates the fair value gap by closing through it. This transforms the fair value gap into an inversion fair value gap, signaling a reversal in price movement to target next liquidity. A one-candle violation typically indicates a strong or high probability reversal setup. Let's analyze some charts showcasing the interplay between FVGs and IFVGs. Point 1. Price action turns a fair value gap into an inversion fair value gaps, precipitating a downward move in price. Point 2. Here, price encounters resistance at the fair value gap before embarking on a downward trajectory. Point 3. A classic inversion. Fair value gap formation triggers a bullish rally, underscoring the predictive power of these patterns. Point 4. This example demonstrates a combined scenario where price transitions from a fair value gap to a bullish inversion fair value gap, subsequently using it as a support level to drive prices higher. Point 5. Yet another instance where the fair value gap acts as a formidable support level, reinforcing its significance in guiding trading decisions. Now that we've covered the theory, let's put it into practice with a real-life example. Okay, first, when I look at a chart, I try to see where the next liquidity is. Now for this day, I know there was a decent news event that played out at 8:30 a.m. That big white candle up at 8:30 generated enough buy-side liquidity for price to want to return to in the near future, and is there for a great target when looking for trades. But remember, we would like to see price take sell-side liquidity first before we can target buy-side. Let's see what happens at 10 a.m. We can see sell side just got taken and left a nice fair value gap. Only problem is the fair value gap is holding price. Remember, we need to see a fair value gap get inverted before we can look for any buys here. Here we see price taking sell side once more before aggressively reject lower price and shifts right through the fair value gap that formed earlier. Now we have an inversion fair value gap and suggest bullish prices. We would now look for any new fair value gaps that could act as support to buy from. We can see a new fair value gap forms from this aggressive push higher. Now we have two options. You could buy when price tests the first new fair value gap, or you could wait for price to invert the second new fair value gap. A few candles later and we invert indeed. Here is a good place to take a long trade. If price closed back below the inversion fair value gap, you want to be stopped out and not sit in this trade. Remember, it's better to cut a trade as soon as they not playing their part to be high probability. And lastly, we can see that price stick to the plan, targeting those buy side we marked out earlier. Notice how a new fair value gap formed and hold price by acting as support. Again, if price closed below that fair value gap, it would have been a good idea to close all positions and take small profit. And there you have it. I hope this video shed some light on how best to use these value gaps. Till next time, and remember, always look for context.